this year, there's been a substantial pivot away from large cap, growth-oriented names to smaller cap, value-oriented names. And we can see this in a number of ways. Welcome to Life in the Markets. My name's Tim Russell, and I'm joined with my friend and co-host, Steve Verkler. And we are here to talk to you about what's going on in the markets over the past week. We're going to give you a little bit of an update for where we are year to date, because it's been a little bit since we've come to you with a general overview market commentary. So that's what we want to accomplish today. Looking back at the week that was, it was very much a mixed bag. The S&P was almost essentially flat, barely positive. The NASDAQ was down about 1.6%. The Russell 2000, these are the smaller size companies, was actually positive about 3.5% on the week. Gold had a strong week, was up over 4%, actually just shy of 5%. Silver had a very difficult week. It was down almost 5%, 4.9. Now, let me just pause on these two. There's a lot more that we should probably say about gold and silver. We're going to come back to it, but just note that there's a very interesting change in the way that the two indices or the two commodities were tied and moving together, and now are kind of moving in the opposite direction. That's something to pay attention to. That's something that we want to see how this develops over the course of the next couple days, weeks, and months. Oil was positive. Bitcoin was down. Notice it was down big, another 12% drop in Bitcoin this year. Bonds, looking at bonds just in general, positive week, but barely, about a quarter of a point improvement in bonds. High yield bonds actually were positive, but again, just barely, 0.15%, which is all rather interesting because the 10-year Treasury yield is actually up from where it began the year. So we're now sitting at a 4.235 Treasury yield, which when yields go up, bonds generally go down. So it's, to me, a little surprising and certainly encouraging to see bonds are actually holding their own in spite of the fact that the 10-year has gone a little higher. Now, thinking about all the things we just talked about on an annual basis, the S&P 500, I said, was just barely up this past week. It's actually just barely up for the year. We're up about 0.8% on the year. The NASDAQ, again, this is the tech-heavy NASDAQ, is up 1.76%. The Russell 2000, again, smaller size companies, up 7.4% year to date. That is meaningful. Notice the very huge shift from the S&P focused, dominated the markets over the last, call it 5 years, to the Russell now actually showing some very remarkable and encouraging growth. Gold, year to date, is still positive. It's up 13%, but pause, that doesn't tell you the whole story. If you look at 3 days, just 3 days in the markets from Thursday, that's the 29th, so January 29th through the 2nd of February, that's 3 trading days, gold dropped 17%. Silver is positive year to date, but it's only positive by 3.29%. And if you look at roughly the same time period from Thursday the 29th through actually Thursday the 5th of February, get this, silver dropped 40%. It's still positive year to date, but only just so much. Gold and silver have seen tremendous volatility. What do we make of it all? There's a lot of reasons and rumors and theories that are being spread around. I'm not going to necessarily share any of those with you here because I don't necessarily know that I believe all of the theories that are out there. But it's very interesting to note that at this point, we've been saying gold and silver may have some positive elements to it, but beware of volatility. And just less than a month after saying that in our annual report, we have some of the biggest volatility we've seen in any of these commodities show up in the course of just a few days. Oil's up year to date 12.5%. So a really positive year for oil. Not positive for the gas prices, I know, but actually right now we're paying under $3 a gallon for oil or for gas. So I'll take it. I'm not going to complain. Going back to Bitcoin now. Bitcoin is down 21% for the year. 21% on a year-to-date basis. And if you go back to October 6th and track the price of Bitcoin from October 6th through Thursday, February 5th, we have seen a 51.5% drop in Bitcoin. Don't tell me that these things are not volatile. We just saw in the course of 3 months, the price of Bitcoin drop precipitously. We're now half of the value it was before. So buyer beware when it comes to cryptocurrencies. And then as we talk about bonds, those particular assets are essentially flat on the year. So again, not a particularly bad thing. So anyway, interesting year on the markets. It was an interesting week last week on the markets. Stephen, I know you had some thoughts on that.
Yeah, last week, some words that were talked about how the market performed last week. I heard the word bumpy. I heard the word rough and tumble. It was kind of all over the place, but it actually ended up just about where we wanted it to be, about even, which was not up or down. It was just kind of right where it was the week before. But it's kind of like a sandwich. Monday, strong growth. Friday, strong growth. Tuesday through Thursday, a little rough. Little bumpy there, especially with the technology stocks as well. But something interesting happened on Monday. A report came out, a manufacturing report. Technically, it's called the PMI manufacturing report, and it showed the strongest expansion in U.S. manufacturing activities since 2002. And that was kind of lost in a lot of the headlines last week with the volatility in the markets, but that there's an increase in new orders, there's an increase in production, and it's really supporting the broadening of the equity market performance overall. So I think it's some good signs in that manufacturing report that we can take away from as well. Also wanted to talk about the Russell 2000. Tim mentioned it briefly, but it's at a record high right now. That's, of course, an index of 2,000 of the small cap and mid cap publicly traded U.S. stocks. But that showed really a lot of growth last week, and we were pleased with that. Kind of the flip of where we've been with the growth values, growth stocks doing so well, and now we're really looking at the large cap stocks doing well as well. So it's very different from last year. So we'll keep an eye on that. But still, the S&P 500 sits less than 2% below its all-time high, still, even with all the volatility that we've had.
It really is.
And the Dow has, of course, we talked about hit records later in the week as well. In case you missed it, there was a brief government shutdown last week. And it was very brief.
Wow.
Compared to the last one, this is one you blinked and it was over. So it was very brief, but fortunately did not have too much of an effect on the markets. What it did do is it pushed some reports that we were supposed to get last week into this week.
Yeah, the February unemployment, it's not coming out till this Friday.
That's the big one. So we're waiting to hear on that, the January jobs report. Yeah, so I know you were on the edge of your seat waiting for that, but we're going to have that for you next week. But just slight issues with the government shutdown, but nothing major, nothing disruptive in the markets as well.
What I would say about unemployment right now is actually we're seeing unemployment looking more positive than we've seen in a while. Maybe I shouldn't call it unemployment. We've seen employment looking positive. The reports that we're getting, the weekly unemployment first-time jobless claims have not been substantially large. So many of the fears about a recession and large-scale loss of employment, it's really not bearing itself out in the numbers. That to me is encouraging.
Yeah. And another report coming out later this week on Friday, the Consumer Price Index report is due as well. And we'll keep a close eye on that. The Federal Reserve is keeping a close eye on that as well. So that'll be interesting to see, especially with the change with the weather. There were some issues with weather in January across the country.
There were?
So that may a few things. Yes.
Hadn't noticed, yeah.
That four-letter word, snow. I think we've heard that before.
Don't use that word.
Yes, so that was interesting. But we'll keep an eye on that for you as well.
We still have snow on the ground, and it's been like a month since we've seen the grass.
Yes, we have not seen the grass since about the early January, exactly.
Which for Pennsylvania, it's not necessarily super uncommon, but it's also not particularly common around here.
Right. So there are also preliminary consumer confidence index reports coming out that are showing rising confidence and lower inflation expectations in February. So that is good news, something to keep an eye on. The sentiment surged for consumers, interestingly enough, with the largest stock portfolios.
Yes.
And so that was interesting. So people who have a large stock portfolio in the market feel better and feel confident about where the market is going. So I think that's interesting as well.
So they actually talk about this as a K-shaped recovery or a K-shaped economy. So you can imagine the letter K, right? You've got the event, right? That's the side of the K, and then you've got a jet up to the right, and then a jet down to the right. The one that's going up is, represents those who are wealthier or more affluent. Their economic experience, their time within this economy is not particularly negative. They're having a good time. They're generally positive about their own personal finances and the overall economy. Whereas people on the lower half of the economic scale, so to speak, are kind of dealing with the opposite trajectory. They're finding themselves struggling to get ahead. They're struggling to deal with inflation. They're struggling to deal with the variety of things that the economy is throwing at them, which is in part why, we look at the economy and say, there's definitely some anecdotal evidence that people at different income strata, different asset stratas are experiencing inflation, experiencing the economy differently. That is what's funny about that is it sounds like this is a brand new thing. Like this is a shift in the overall market. This is a major shift in the sociological economic landscape of America. I've got a news flash for you. That's the way it's always been. I mean, it doesn't take a rocket scientist. People get so excited about a K-shaped recovery and how it's so much injustice and inequity. No, this is how economies work. People who have assets generally are going to deal with difficulties in the market, difficulties in the economy, difficulties with inflation better than those without. It's not rocket science. And it's also nothing new. And it's not that all of a sudden everything has become unjust. So for those who are beating the warpath about the K-shaped recovery, it's just not the thing. It's just not a thing. Just let it go. Not a big deal. All right, getting off my hobby horse.
Well, something else that was in the news actually a week before last, but we wanted to revisit it this week for you, was the Federal Reserve. They were in the news for a couple of reasons. One was they met and the interest rates stayed the way they were. They voted to keep the interest rates where they were. That was not as much of a surprise, but what was in the news is that President Trump announced his choice for the next Federal Reserve chairman, and his name is Kevin Warsh. And he's an interesting guy. He has a lot of experience in the markets, especially at the Federal Reserve. Interestingly enough, during President Trump's first term, he actually considered Kevin Warsh for the first time for the role of Federal Reserve Chairman. So this is someone that's been well known in the markets. The Wall Street is very familiar with him. He has a lot of experience, a lot of credibility, which is especially important. Now, I think what going forward for this year, as far as expectations, he will not move into his role if he is confirmed until May. But the general consensus is that there will be a couple of at least 2 interest rate cuts, perhaps more, but it'll probably be incremental over the next year or so. So it will not be too much of a surprise if we see that. I don't think President Trump would have appointed him and had him as his choice if he wasn't expecting that to happen. Yeah. But what will be interesting to see is how Kevin Warsh develops in that role. He tends to be more looking at signals in the market, not so much as set on the models that the Fed has. So it's going to be interesting to see how he proceeds, because Chairman Powell has been kind of the opposite. He's gravitated more towards sticking to the models at the Federal Reserve and not necessarily picking up on clues in the market.
So I think that difference reflects the fact that what we see with Warsh was he's a trader. He knows how to do it. He knows how markets work, and he's committed to allowing the markets to function without government interference. He is not an academic. It's not to say that he doesn't understand academics and he doesn't understand the higher level math and higher level economic principles, but he doesn't have a PhD in all of this, and that's not what drives him. Whereas our current Fed and many of our previous Feds have been primarily academicians rather than functional people who actually get out there and get the job done. And for me, as someone who sits here in the market and works in the markets, I really love to see this take for someone who's able to get in there and just let the markets function properly, allow the Fed to be reformed wisely and effectively, and have a more limited role within the scope of the economy rather than drifting into other areas that are not part of its mandate. And again, I think that in particular will be a very refreshing change in the Fed.
Yeah, I agree, and I think that it'll be interesting to see how Kevin Warsh handles the role of the Fed going forward. I think it'll be a very different role that he foresees for that. As far as what's coming up this week in the market, we already addressed some of the reports that were pushed into this week. The Consumer Price Index report will be coming out later this week, and there will also keep an eye. There's some congressional meetings happening this week, hearings on minerals, telecommunications, and digital media consolidation. So there are going to be a lot of people keeping an eye on how Congress and what the outlook is for in those different sectors of the market. So keep an eye on that as well.
As we kind of shift towards the end of our video here, I wanted to give you a very quick overview of what's actually driving the markets right now. In the past, and we've had multiple videos where we talk about the fact that the market is driven by tech, by some of the biggest names out there, but by the Magnificent Seven. This is both an encouraging and discouraging thing because it doesn't really show the true value of the overall market. This year, there's been a substantial pivot away from large cap, growth-oriented names to smaller cap, value-oriented names. And we can see this in a number of ways. If we look at the S&P 500, we've noted that the S&P 500 is something called cap-weighted. That means that the larger the company is, the more allocation it has within the S&P 500. The smaller the company is, the smaller the overall impact or allocation it has within the S&P. When you look at that index, year to date, it's roughly flat. But if you look at the equal weighted S&P, where you give everything the same weight, you don't cap weight anything, it's actually up about 5% year to date, which just shows you that the pivot is coming away from the big names and everyone generally is actually doing better in the S&P 500 than just those few very large names that sucks the oxygen out of the room. Now, I want to show you a chart from a website that I go to a lot. I share with clients because I think it's a helpful visualization. It's called finviz.com, and they have an S&P 500 heat map. Now, there are two things that I want you to see about this S&P 500 heat map. The first thing is notice that the different boxes are different sizes. The relative size of the box tells you the relative weight that stock has within the index, and the bigger that box is, the more allocation or the more pool it has on the rest of the index. But you'll see that there are some very, very small boxes where those the stock may be a great stock. It might do really well or poorly, but it's such a small allocation of the overall whole, it's not going to do much. So that's the first thing. The second thing I want you to know is that you'll notice that there are different colors. We've got reds, and we've got grays, and we've got greens. The reds, obviously, they're negative, and this represents year-to-date performance, and the greens represent positives, and gray somewhere in between. Notice on this report that the reds, more reds out than there are greens in the large companies. But you'll see that most of the smaller companies have a lot of green. So for me as a trader, for me as an investor looking at this, that gives me a lot of encouragement because, again, some of these big names have been taking all of the oxygen out of the room, and we are seeing a fairly substantial shift. Now, before you go and changing all of your investment strategies, plans, and goals, just know that a month of trading activity does not a new trend make. We want to see this carry on for another couple weeks, another couple months to really say that this is a massive shift. We have seen that there are a lot of things within the markets where we see some temporary shifts that don't actually carry itself out. This is one shift, however, that I personally will welcome. I would love to see more of the smaller companies actually get the kind of love that they really are due because of the value that they're creating. So with that, I want to wrap up and use our verse of the day. We're going to be looking at an excerpt from the book of James, chapter 5, verses 1 through 6. And the excerpt says this: "Come now, you rich, weep and howl. Your gold and silver have corroded." I chose this verse for lots of reasons. One of them is that he talks about gold and silver corroding, and we have just come off some of the worst weeks for gold that we've seen in the history of following gold and silver markets. Don't put your trust and confidence in gold and silver. And in the context of the book of James, James was really addressing these individuals who had power and authority, who had wealth and possession, who are using their wealth to manipulate, to persecute, to harm those who were lower income. These are maybe wage workers. They're withholding wages from their employees. They're using money as a weapon against individuals, and they're withholding the thing that God has called them to not withhold, to pay your workers the fair price, to seek justice in the economy rather, or in the courts rather than manipulation and bribing. And so for you today, for you listening to this, just remember, read over James chapter 5, verses 1 through 6, and just think about what God has for you with money. Are we living in righteousness with how we interact with our employees, with the world, and with seeking the glory of God in all things? And with that, I hope you have an absolutely wonderful week. Take care, God bless, and you be safe in the markets.
Have a good week, everyone.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.